we have talked a lot here about the fee wars and what it means for consolidation in the industry. Interesting development last week. The hedge fund run by Nelson Peltz has taken an almost 10% stake in Invesco and in Janus Henderson, signaling they want to push some of these asset managers to either be more efficient or even possibly consolidate. We have talked about this before. Armando, you're the king of the hill here. BlackRock and Vanguard are the two biggest ETF families out there. Let me just ask you, Armando, and all the guys, all three of you, do you feel that consolidation in this industry is inevitable, and 2021 will see more consolidation?
Yeah, Bob, we've said for a long time that the scale is necessary, and that leads to consolidation in the industry. Ultimately, if you think about the scale, what it allows you is to bring innovation to the market, to deliver quality and value to investors. So I think scale is necessary. And I think that without the scale, I mean, think about what we've done this year, our ability to bring to market at the scale with quality over 40 new products. So that's something that you need to do with the scale. So yes, we've seen it before. We've mentioned that before. We do believe in consolidation in the industry.
Yeah, Jim, that seems to be the answer to everything. Bulk up on your assets under management. Easy to do if you're BlackRock. It's a little tougher if you're everybody else out there, right?
It definitely is. Look, you can count the number of mutual fund companies that an average investor could name. Probably two: Fidelity, Vanguard, maybe T. Rowe Price. There's an industry that went through massive consolidation. ETF industry clearly going to do much the same. And for the benefit for the retail investor and the professional advisor, it usually leads to lower costs for the underlying products, whether they're actively managed mutual funds, passive indexes, or ETFs. So I think you're absolutely right, Bob and Armando, that trend is in place.
You know, Kevin, I'll leave the last word with you. Maybe the answer, if you're struggling, is to come up with new innovative products. I mean, look what you did. You set up O'Shares, and you've got a dividend fund that doesn't just buy the high dividends. You overlay it with a quality overlay. We just talked about that. There's an innovative product. You're doing pretty well like that. Don't you think the future is, other than just, oh, let's get more assets under management, let's have more innovation, more innovative products? Isn't that the answer, or do you have some other brilliant explanation or what we should be doing?
No, I think you're right. I think you need both. I mean, the truth is there is a barrier to entry into the ETF market now. You don't see a lot of new firms opening up because until you get $1 billion under management, you're not making any money. Compliance costs are significantly higher than what they were just a few years ago. So that's a factor. Innovation really matters. Clearly, you know, getting the first 50 million into an ETF gives you some indication of whether there's interest there or not, but you never know till you go out there and put it out. I mean, I built these indices to serve, you know, my companies and my family trusts. I like to have a hand in what I invest in, and that's why I did it. I mean, it's a little unique because I can afford to seed my own products. But at the same time, innovation will always drive this market. And the thing about the ETF itself as a structure, it will ultimately be the most successful investment vehicle for institutions and individuals because it's transparent, it's efficient, it's low cost, and it's incredibly tax efficient. So I feel that we're really only in the fourth, maybe the fifth inning of what this sector is going to be. And the innovation that comes in the form of factor-based or actively managed or all the other ideas that are being floated are incredibly healthy. Obviously, because of COVID, we haven't gathered like a flock somewhere like we usually do in South Florida, but hopefully next year we'll do that again. And I love those sessions and those seminars and when the industry gets together and says, what can we do for clients? But clearly we've made it far less expensive and we've delivered tremendous diversity as an industry. And the clients know that whether they're a sovereign fund in the Middle East or they're an individual investing in California. We do it for everybody.
Yep, and that's why the show exists, ETF Edge, because ETFs are a very efficient investment mechanism. Thanks, guys. That does it for this week's ETF Edge. My thanks to Armando and, of course, to Kevin and Jim. And remember, you can see all of our podcasts on etfedge.cnbc.com. And don't forget, we've got, in addition to the podcasts, we, of course, got the programs. You can see that and the podcasts. And we talk all about individual ETFs on a regular basis. And in the podcast, we go into a little more detail about what's going on in the ETF business. In this week's podcast, I'll talk a little bit more about the consolidation in the ETF industry that we were just talking about.